Hello and welcome back to our second Camtasia lecture dealing with chapter 13, capital project decisions. So in this video we're going to go ahead and look at net present value. Remember, net present value is just another tool that we can use to make a capital budgeting decision that looks at cash flows. So when we're looking at net present value, basically what we need to do is compare all the cash inflows with all the cash outflows. Sounds pretty easy, right? The only problem is we have to bring those cash inflows and cash outflows to the present value, meaning what are they worth today? These cash flows, in or out, are going to happen at some point in time in the future, right? We know their dollar value at that specific time in the future. We want to know how much is that cash flow in the future worth today, okay? So in order to do net present value, we got to make two assumptions, and these are simple assumptions. All right, by making these assumptions, it makes calculating net present value a lot easier for us. First and foremost, we assume that all cash flows other than the initial investment are going to occur at the end of the period. Okay, so we have 4 years of net cash inflows. We assume that each 4 years of net cash inflow happen at the end of the year. Okay. Also, too, we're going to have a factor, right, that we're going to have to discount these cash flows at. The factor is based on time, obviously, and it's also based on an interest rate. Okay, so to make it easier, we automatically assume that all cash inflows that are generated, what we do with those is we immediately reinvest those at the rate or at the same rate that we discount those cash flows at. Okay, so we call that the discount rate. Might be a little confusing now, I get it. It'll become a lot more clear when we do an example, but for right now, just know the two simple assumptions, right, or simplifying assumptions. All cash flows happen at the end of the period, with the exception of the initial cash flow. And then all cash flows are reinvested at that discount rate. We'll see what the discount rate is in a minute. But let's go ahead and let's look at an example of net present value. Okay, so Lester Company has been offered a 5-year contract to provide component parts for a large manufacturer. Hey, this sounds great, right? We got a 5-year contract. Okay, well, I need to consider, should I do this? Well, obviously that's the choice, sorry. But how do we do that? Well, we look at all the cash inflows, all the cash outflows that are going to happen in the future, and we bring them back to today's dollars. Okay, so let's look at, in order to do this, in order to fulfill this 5-year contract, we have to invest in special equipment to do that. That special equipment costs us $160,000. Okay, we're going to need working capital, right? That working capital that's required to do this is $100,000. Okay, they say that, oh, by the way, 3 years into the contract, you're going to have to realign the equipment. So we're going to have, basically, in year 3, a $30,000 net cash outflow of repairs and maintenance. Okay, salvage value on the equipment in year 5. So basically what that means is at the end of the contract, 5 years or 5 years from now, the machine or the special equipment that we paid $160,000 for, at the end of that 5 years, we could sell it to somebody else for $5 grand. That's what we're assuming. Okay, they tell us they give us some other information. They say, hey, your sales revenue from the parts that you sell are 750,000. Great. Cost of goods sold 400,000. Okay. Salary, shipping, etc., all those other expenses, $270,000. We have enough information here to figure out what is the net present value. Well, not quite. Not quite. We're almost there. But at the bottom, those annual cash revenues and costs, we can figure out what the net cash inflow is. Very simple. So each year, from 1 through 5, each year we're going to make $750,000 of revenue. We need to subtract the cost of the parts sold, right? We had to make those parts. We incurred costs. That cost was $400,000. Then we have other expenses, other operating expenses, right? Salaries, shipping, utilities, things like that, which are $270,000. So basically, I'm going to have a net cash inflow of $80,000 each year for 5 years, right? 750 minus 400 minus 270, okay? Now, they tell us that at the end of 5 years, that working capital, it will be released, and we can use that money elsewhere. Okay, good. They also tell us that the discount rate is 11%. Okay, that's very important. That's what we're going to discount. We're going to use that as our discount rate, right? We're going to assume 11%. So any cash that we receive in the future, any cash inflows that we receive, we assume we immediately reinvest those net cash inflows at 11%. Do we accept the contract? Well, I don't know. Well, we already did step 1. We already calculated the net cash inflow from operations, right? 80 grand. Perfect. So now we have to build this net present value table, okay? Basically, what we need to do is we need to list each cash flow, whether it's in or out. We need to say, when does it happen and what year does it happen, what's the cash flow, and what's the factor, okay? If it happens now, it's always a factor of 1, okay? Because you don't have to discount it if you're paying it out now. It has no time value whatsoever. It's now, right? The time value of the investment is equal to whatever the current market rate is, okay? Okay, so now, the first thing we do is we recognize that, hey, we have annual net cash inflows. That means from year 1, 2, 3, 4, and 5, each of those years, we're going to make $80,000, okay? Hopefully we should be cool to there, right? And then we get a factor. The factor is 11%, or the factor is 3.696. Where the hell did that come from? Not a problem. In your book, in appendage, bear with me here, in appendage B, and let me get there. Okay, we have this little table right here. This is the present value of $1, okay? Because we have annual net cash inflows, that means every year we're getting the same amount of money. That's an annuity. That's a stream of payments. So we need to use the present value of $1 annuity. So the present value table, the present value of $1 is on page 677. Present value of an annuity, $1 in the rears. We don't want to use that one. Or wait, yeah, we do. I'm sorry, I apologize. In the rear. So what they did, how they figured out that factor of 3.696, they went to present value of an annuity, actually, bear with me here for a second. I apologize. I'm just looking for the right table in the book. Why do we have... I apologize. We're good. It'll probably help you guys if I probably edited these videos. I haven't quite figured that part out yet, how to do that. So we do want to use the present value of an annuity table in the rears. Okay, we know that we have 11%. So I go to the 11% table and I look for the periods. Well, the periods are 5 years. So if I meet between, come down from 11% and go over from the right, or sorry, from the left, I move to the right from period 5, I end up with 3.696. So that's the factor that I use. Okay, so we multiply 80,000 times that factor. That's how much those stream of payments over 5 years are worth today. Okay, then we do the realigning of equipment, right? It happens once. In year 3, we have to shell out $30,000. Okay, well, $30,000 3 years from now, that's great. How much is it worth today? Guess what we do? Go to our present value of an annuity table and we find 11%, and we scroll down until we hit year 3 and we have 0.731. Same factor we have there. Okay, good. So we multiply those two out and we see that at year 3 I have to shell out $30,000. How much is that worth today? Well, today, that $30,000 3 years from now, today it's worth $21,930. Beautiful. Perfect. Then we do the salvage value and the working capital that's going to be released. Okay, so in year 5, I'm going to get $5,000 from selling the machine. In year 5, that working capital that I have tied up is going to be released. So I need to figure out how much is 5,000 5 years from now. How much is it worth today? I find my factor, which again, I go to 11%, scroll all the way down to year 5, and I get 0.593, which is the same factor that we used. Okay, so that $5,000 that I'm going to get 5 years from now, how much is it worth today? $29.65. Same thing with the $100,000. Okay, 5 years from now, basically I'm going to have $100,000 worth in cash. Okay, great. How much is that worth today? $59,300. Okay, so when we add all these up, notice we have negatives and positives. The negatives are just the cash outflow, positives are the cash inflow. The total present value, okay, is $76,015. There is a positive net present value, meaning when we take all those future payments that are going to happen at different times of the year, or let me rephrase that, they're going to happen in different years over the life of the project. We bring them back to today's dollars and we sum them up. If we have a positive number, which we have $76,015, we're going to accept that project. Okay, think about it this way. Let's say, for example, that you had to shell all this money, these cash flows. Let's say that you had to shell them out today, right? You're either going to get it today or you had to pay it today, all of them. It's all going to happen in one fell swoop. Well, these are today's dollar values. I'm in the plus. I'm in the black here, right? 76,015. So anytime the net present value is positive, you're always going to accept. Okay? Let's do another quick example. All right. So let's think about this one. Denny and Associates has been offered a 4-year contract to supply the computer equipment for a local bank. Hot dog, sounds good, right? Okay. Well, we got to buy equipment. That equipment is going to cost $250,000 today. The working capital that required is going to be $20,000. That happens today too. So these are all negatives because they're cash outflows. Right? They tell us that in year 2 we're going to have to upgrade the equipment. 2 years from now we're going to have to spend 90 grand. So that's an outflow. They tell us that, oh, by the way, at the end of the contract in year 4, this equipment that you paid $250,000 for is going to be worth $10,000. So you're going to sell it and you're going to get $10,000. That's a positive, right? Because it's a cash inflow. The net or the annual net cash inflows are $120,000. That means each year, year 1 through 4, I'm going to have a cash inflow of $120,000. That's a stream of payments. That's an annuity. Okay? They go on to tell us that, hey, this $20,000 at the end of year 4 is going to be released. And they say that we require a 14% return. Okay? So basically what that means is that 14%, we're going to use that as our discount rate. Okay. Now, question 1, let's just look at it real quick. Asks, what is the net present value of the contract with the local bank? Okay, well, we got to figure it out, right? It's easy to do. Okay, bear with me here. We're gonna, that chart that we saw, we're basically gonna create the same thing, right? When does it happen? What's the year that it happens? Right, so we're going to have year. I'm going to abbreviate and say CF for cash flow. We have a 14% factor rate here, or a discount rate is 14%. And again, they said that that's the required rate that we require. So we're just going to take it as our discount rate. Then we have our PV, right? What's our present value? Okay, easy peasy, right? First I have to invest in that equipment. That equipment is $250,000, right? When do I pay it? Well, I pay it now. So I get 250,000 bucks. Factor of 1. Right, because it's happening now, it's always a factor of 1. 250K. Okay. The next thing we had was that working capital. I'm just going to abbreviate and put WC for working capital. That happens now. Again, that cost is 20,000. 20K. When's that factor? Well, it's 1 because it happens now, always a factor of 1. We now have 20K. Okay, what's the next thing we had? Well, if you remember, the next thing we had was the next thing we can consider is that net cash inflow. Okay, so that was the I'm going to say NCF for net cash inflow. It was $120,000, but when does it happen? It happens years 1 through 4, right? And we get 120K. Well, great. I got to figure out what the factor is. Not a problem. This is a cash flow. It's a stream of payments, 1 through 4. Guess what I'm doing? I am going to go to the chart that says present value of an annuity in the rears, and I'm going to look at 14%, and I'm going to go to year 4. And that should be 2.914. So I'm going to say 2.914, and I'm going to multiply my cash flow by the factor. So that's going to be 120,000 a year for 4 years times 2.914 ends up giving me 349,680. Okay, no problem. Now, in year 2, I have the upgrade. That's going to happen in year 2, right? How much am I going to have to pay for that? Well, I'm going to have to pay 90 grand. How much is that 90 grand worth today in today's dollars? Well, let me figure it out. It's a one-time cash flow, so I'm going to go to my present value of $1. I'm going to find 14%. I'm going to look at year 2, and I got 0.769. So right in here, I am going to put in my factor of 0.769, and I multiply 90,000 by 0.769. That gives me $69,210, and that's an outflow, so it needs to be negative. The 250,000 that we did up here is also an outflow, so that needs to be negative, and so is the 20,000. Okay. Now the next two things I have is the fact that my working capital is going to be released, and I have a salvage value. So let's do the salvage value. When's it happen? Year 4. What's the amount? 5,000. I need to figure out what my factor is. It's a one-time payment, happens once. So I'm going to go to my present value of $1. 14, year 4, which is 0.591. So I'm going to put that in. 0.591, and that ends up being 5,920. It's positive, it's an inflow, so I don't put it in parentheses. Same thing with the working capital release. That happens in year 4. I release 20,000. What's the factor? Well, it's 14% at year 4. I already figured that out for salvage value. It's 0.591. That amount ends up being 11,840. I sum all these numbers up and I get 28,230. So my answer is B. And there it is right there. Okay, I just wanted to walk through and show you how to use those two tables. Okay. If we look at this one, notice that there's another way we can look at the net present value. Okay, it's the same, the first example we just looked at, right? Same example. But what happens if we change up something, right? What are we changing up? Well, what if our net cash inflows change. Okay, so we have a 5-year contract, right? To provide component parts, right? $160,000 special equipment, $100,000 in working capital, $30,000 to maintain the equipment, salvage value $5,000, annual cash inflows still the same, right? Let's assume that at the end of year 5, working capital again going to be released. Company uses a discount rate 11%, right? What if we already calculated in the previous example that this was 80,000, right? 80,000 over 5 years. But what if the working capital changes? Meaning, what if we have uneven cash flows? Just like we had with the payback method, those uneven cash flows, we can have the same thing here. Okay, let's look at an example. Let's assume that each year we have different numbers, right? Meaning, let me rephrase that, I'm sorry. Pump the brakes. We have different cash flows, right? Year 1, year 2, same. Year 3, up, dips down. Year 4, year 5, it's back up to 80,000. What we need to do then is discount each of these cash flows, okay? Meaning, when does it happen? Year 1, at a factor or a discount rate of 11%, we have to find the factor, okay? Look at the next net annual cash flow. It happens 2 years from now, right? So what do? Well, we go to the chart at 11%, look at year 2, it's 0.812. That's what we used, right? Look at year 3. Year 3 says, hey, $50,000. Well, okay. In year 3, I'm going to get $50,000. How much is that worth today? When does it happen? Happens in year 3. Okay. So I go to my 11. I look at year 3, and I get 0.731. Okay. I do the same thing for each year. Notice what happens as the time increases, right? Look at the present value amount. It decreases. So the longer we go out, or the longer we have to discount something back, the less it is worth today. Okay? And again, this just walks us through each step. I'm not going to bore you with that. You have the PowerPoints. I just wanted to show you and kind of point out that it's important that we need to factor in or take into account when does this cash flow happen. Okay? Rule of thumb, always, if we have a positive net present value, we're going to accept the project. Why? Because we have a net present value, that means that the return, the actual return on this project, is greater than the required return, right? We require 14%. Okay. Because we have a positive net present value, the return on this investment, meaning the return on this project, is higher. Okay. If the net present value is 0, you still accept. Well, why? Well, because that means that the rate of return that we require is equaled to the return on this project. Negative, we're always going to reject. Why? The reason why is, number one, it's unacceptable, but why is it unacceptable? Because the project that we're going to invest in, or the machine that we're going to invest in, promises us a return that is actually less than what we require, that 14% or that 11% that we require. If we have a negative NPV, it means that that project is providing us with less of a return than we expect. Okay? So choosing a discount rate. We're not going to go into too much detail. Basically, we want to use our cost of capital, right? That's a good a good benchmark to choose, right? Why? Well, because what is cost of capital? Well, basically it's the average that we have to pay for our debt and for and to our stockholders. Okay, the dividends, the return that we give them. So we want to take the cost of capital. Cost of capital is how much do we got to pay these people to either borrow money or get them to invest, right? Let's see. That's pretty much it for net present value. We'll come back and revisit it when we hit the end of the chapter and we do the problems in the study guide. Okay, so don't forget what's important here, right? The main takeaway: identifying what are inflows, what are outflows, when do they happen. Once I determine when they happen, I have my discount rate. I gotta know which table to go to. If it's a one-time payment, we go present value of a dollar. If it's a stream of payments, it's a present value of a dollar of an annuity in the rears. Get those factors, calculate our net present value. If we have a positive NPV, we invest, it's acceptable. If we have a zero NPV, we still accept. If we have a negative NPV, we reject. So tune back in for our next video where we are going to look at internal rate of return method.